Welcome back to Money Pop. Something strange is unfolding in the gold market right now. Prices are climbing faster than almost anyone expected, almost as if the world is quietly stepping back toward the gold standard. Over the past 2 years, gold has soared from less than $2,000 an ounce to as high as $5,300. It has since pulled back to around $4,700, and that leaves us with a very important question. What happens next? Is this a bubble that is about to burst, or are we heading towards $6,000, $7,000, even $8,000 an ounce? About 2 years ago, I made a video on this channel explaining why I was buying gold heavily. At the time, prices were near $2,000, and that analysis turned out to be correct. Gold has now climbed to roughly $5,000. In this video, I want to walk you through why I'm still buying gold and why I believe prices will keep rising towards $6,000 and $7,000. To understand where gold is heading, we first need to understand why it has been rising. The biggest reason is that the United States debt is growing faster than ever, and the government keeps lifting the debt ceiling. Every time Washington hits its limit, Congress meets, debates briefly, and almost always agrees to raise it. That sends a very clear message to investors. The dollar will be devalued because more dollars in circulation means a lower value per dollar. And when the dollar weakens, gold rises by itself. Gold is a fairly useless asset. It does not produce anything. If you owned all the gold in the world, it would just sit there and shine. Meanwhile, United States treasuries pay interest, which historically made them far more attractive than gold. That is why, even after Nixon ended the gold standard, the petrodollar system and global demand for treasuries worked so well for decades. But now investors are realizing that the United States government is borrowing more aggressively than ever, and trust in the dollar is eroding. That is why the demand for gold today is driven primarily by central banks. Whether it is China, Japan, or European nations, central banks hold enormous amounts of United States treasuries. As confidence in the dollar fades, they convert those treasuries into gold. This is exactly why gold prices have moved up so dramatically. If you look at the total market value of United States treasuries compared to the total market value of gold over the past several decades, treasuries have always been worth much more, but something fundamental has shifted. For the first time since 2024, the total market value of gold has surpassed that of treasuries, and the trend is clearly continuing upward. Gold did not suddenly become more useful. What happened is that central banks started selling treasuries and buying gold instead, lifting its value. In effect, we are already back on a gold standard. It just has not been officially announced. It is not the yuan replacing the dollar as the global reserve currency. It is gold. Now the next question is whether the United States actually plans to keep raising the debt ceiling. The answer is yes. And the more important question is by how much. Looking at the past 20 years, every single year the debt ceiling has been raised. But something interesting happened starting in 2013. Congress essentially said that they were tired of voting on the debt ceiling every time. So they decided to give the government what amounts to a blank check. They would simply pass a bill later confirming whatever the new debt level happened to be. If debt grew from $15 trillion to $20 trillion, they would just confirm $20 trillion as the new ceiling. If it climbed to $30 trillion, that became the new ceiling. Now imagine you are a central bank in China, Japan, or anywhere else. What does that tell you about the value of the treasuries you're holding when the United States government is openly printing as much money as it wants? That is exactly what happened between 2013 and 2021, and the total debt doubled during that stretch. Then the ceiling was lifted by another $2.5 trillion. When Donald Trump returned to the presidency, he raised the ceiling again by $5 trillion, bringing it to $41.1 trillion. Here's a simple question. What is the total United States debt today? It stands at $39.3 trillion. With a ceiling of $41.1 trillion, the government is on track to hit that ceiling by the end of this year. Normally, Congress would pass another bill to raise it. But debt is growing so quickly that there may not even be time to do that properly. Congress will likely just allow the government to keep borrowing without limits. Why? Because the United States government is moving into another major conflict, and this one could become the largest since World War II. That is the conflict against Iran. The approach is step by step because Washington is cautious. Iran is a large, mountainous country, and the government is not ready to throw everything at it at once. So first comes the decapitation of leadership, then blockades. Once the strategy of the opponent is understood, the ground invasion may follow. But a ground invasion will cost trillions of dollars. That is why Congress will essentially ignore the debt ceiling. Let the government print as much money as needed and then later confirm whatever the new ceiling becomes, perhaps $45, $50, or $55 trillion. That confirmation will probably happen under the next president, whoever that may be. Central banks around the world look at this and think our treasuries are about to lose enormous value. So while there is still time, they convert them into gold. If treasuries lose value, gold will not. And there is another fear. The United States can freeze assets just as it did with Russia. When the conflict between Russia and Ukraine began, Russia had about $300 billion of various assets in American and European banks. Those assets were frozen, but they still generate interest, and that interest now flows to Western governments rather than Russia. So if you're China or any other nation and the United States moves against Iran in a way that triggers a global energy crisis, you have to worry that speaking out could mean having your treasuries frozen too. That is a huge incentive to sell treasuries now. But when you sell, you need somewhere to put that value. You need an asset to back your economy. And right now, the only real alternative is gold, because there is no true replacement for the dollar yet. This conflict also gives the United States government a perfect excuse to raise the Pentagon budget to $1.5 trillion. Currently, the budget sits near $1 trillion. Increasing it to $1.5 trillion would be a 50% jump in a single year, which sounds extreme. But if there is a major conflict to fight, that becomes the justification. Taxes cannot easily be raised, since they were recently cut, and Americans are not eager for a new conflict. That is why the United States is already running a deficit of around $2 trillion this year and last year. Adding $500 billion to the Pentagon budget could push this year's deficit to $2.5 or even $2.7 trillion. And that is before considering what happens next year if the conflict expands. What message does that send to the central banks holding treasuries? It only accelerates the move into gold. Here are the main reasons gold will likely keep rising. First, the new debt ceiling could end up at 50 trillion, 60 trillion, or even higher depending on the cost of the conflict. Second, with the Strait of Hormuz under pressure, treasuries can no longer easily be used to buy oil. For decades, countries like China stockpiled treasuries because Saudi Arabia and other Middle Eastern producers only accepted dollars for oil. Treasuries paid interest while dollars lost value to inflation. But if Middle Eastern oil cannot move freely, those treasuries lose their purpose. They sit there losing value while the United States prints more money. So China, India, South Korea, and others have every reason to start selling. At the same time, Gulf nations like the United Arab Emirates, Qatar, and Saudi Arabia are among the largest investors in United States treasuries. They sell oil, receive dollars, and reinvest a portion into treasuries or American stocks. But if they cannot sell oil due to a naval blockade, they have no new dollars coming in. They might even sell existing investments to import essential goods or buy weapons during the conflict. Every incentive points towards selling treasuries and buying gold. The world is quietly moving toward a gold standard. The final reason is uncertainty about the conflict itself. No one truly knows how it ends. If it ends in favor of the United States, the dollar continues as the global reserve currency. But many signs suggest it could drag on for years, draining American resources and pushing the world into a multipolar system. Investors always seek safe havens during uncertainty. The old safe haven was treasuries. The new one is gold. So who is buying all of these treasuries that others are selling? The Federal Reserve. That process is called quantitative easing, where the Fed prints money to buy treasuries and prevent the bond market from collapsing. They did it in 2008, in 2020, and again in 2021. In December of last year, the chairman of the Fed signaled that quantitative easing would resume. It is not on a massive scale yet, but the process has clearly begun. Personally, I prefer investing in real companies because historically they outperform almost everything else. But in this environment, gold makes perfect sense. Because the United States government is openly signaling that the dollar will be devalued. The bigger question is, which other assets will rise alongside gold? Identify those, and the next few years could be extremely rewarding because massive government spending tends to push the stock market higher, even during difficult times. Thanks for watching. This is Money Pop signing out.